Akil, happy Thanksgiving. Hope you're enjoying the festivities. As you recall, I'm tackling the daily chore at the moment. At this point, I need confirmation that I am on the right track and that my plan for the next few weeks is efficient. My focus has been on filtering out losing trades and using fixed risk reward targets. My concern is curve fitting. I've sampled 10 years and over 100 trades per pair. My filters take that number of trades down to 46 for one pair and around 60 to 70 for most others. Attaches a backtesting report, euro dollar, with comparison of filters versus no filters. Question 1, could you explain curve fitting and am I doing this? So, does anyone not know what curve fitting is? All right. Curve fitting is essentially this. You can look at it from the negative standpoint, right? So going through your back testing and adding filters and doing whatnot is is not curve fitting, right? That is just you making tweaks and seeing the results are. Curve fitting is isolating a specific time to give you the results that you want to see. So, for example, let's say I had an equity curve that looked like this. Let's say I'm starting from 2010 and I had an equity curve that looked like this. I think you guys would all agree. Is this an equity curve? If this were the results of your back testing, is this something that you would trade this 10-year period? Probably not, right? Because you're basically break even at the end of 10 years, right? You start off a little hot, you go into consolidation, you hit a hot streak, and then you gotta give it all back, right? So this would not be a strategy, in my opinion, that is worth trading. However, if I'm a sleazy salesman, and we had a good question about this on the chat over the weekend about we had a few traders that were offended by the commercials and whatnot that come on before YouTube videos about people selling systems, right? And you hear all these things. Right? You ever hear these things where, and you hear it on the internet all the time, actually, but you ever hear these trading gurus sell these courses where it's like, hey, I made 8,000% returns, my system. You ever hear some outlandish stuff like that? Or you ever see people on the internet sharing their P&L statement and it's like 18 blue things, which is, I guess, is profit, and then one red thing, right? So what they're doing is this, right? They're taking realistic results that look like this, and they're only showing you a portion. So I'm looking at this right here and I'm saying, hey guys, in just 3 months, I generated a 1,200% return. And it's not a lie, is it? Technically, you're not lying, which I guess is that's how they justify the curve fitting, because it's not lying, right? In 3 months, guys, in 3 months, I generated an 1,200% return. Well, prove it. Here you go. It's not technically a lie, but it's not the entire truth. It's kind of like when you hear, I used to be, Allen Iverson I was a fan of Allen Iverson growing up. He played for the Philadelphia 76ers, and he was a volume scorer. So he would have nights where he scored like 50 points, and the headline's like, Allen Iverson scored 50 points. But if you watch the game, he took 100 shots to get those 50 points, and his team lost by 30. But the headline stands out. Allen Iverson, 150 points. Kobe Bryant's the same way. May he rest in peace. So this is curve fitting. Curve fitting is when you're at least the way I've always interpreted it is when you're taking the portion of the curve or the results that you want to see, and you're basing your final judgment off of that instead of looking at the entire picture. Right? So if this were a strategy, for example, let's say you were making a tweak, you changed the risk reward to 1.5 to 1 from 1 to 1, and you see that during a small period of time, it had a really, really, really good effect on your trading results. But overall, it eventually kind of took you back into the gutter. that would be you telling yourself, wait a minute, no, this 1.1 to 5 works. And I'm going to trade this because I'm only going to isolate the part that worked for me, and I'm going to ignore the area that didn't work for me. So that's different than adding filters, right? Adding filters isn't curve fitting, because when you add a filter, if you're doing it the right way, you add a filter, a tweak, an adjustment, whatever you want to call it, are you doing it for just a specific point of time, or are you looking at the entire picture? You're looking at the entire picture. So you're not necessarily trying to force something in there and make it stand out to give you the result that you want. You're looking at the full picture, and that's going to be a different thing. So I wouldn't say that you're curve fitting by finding a filter to eliminate some bad trades and maybe profit more on good trades, right? You're just adding a natural filter. It would be curve fitting if you're specifically ignoring periods of time. If you're saying, I'm just not going to count 2008, 9, and 10 because they were bad, but I am going to count 2011, 12, and 13. Great.